Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Morgan Stanley's layoffs and the shape of Wall Street's future. That's how the Wall Street Journal describes Morgan Stanley's latest round of layoffs, around 2,500 people, cutting into investment banking, wealth management, and asset management at the same time. This isn't a one-off cost program. It's the visible tip of how a mature Wall Street franchise retools itself for a slower China, a choppier deal environment, and a world where technology quietly replaces some of the old profit engines. Think about the central figures here, the senior leadership of Morgan Stanley. They're not founders, but they're in a founder-like role when it comes to the institution's future. They're builders of the new mix. They're allocators of people, technology, and brand. And they're also the constraint, because their past success, massive wealth management growth, big-ticket M&A, institutional trading, shapes how they see the world. What worked for a long time? For more than a decade, Morgan Stanley's story was simple. Shift from a balance sheet-heavy, trading-driven firm to a more stable, fee-based wealth and asset manager, with elite investment banking on top. Acquire big platforms, bring in trillions in client assets, and compress earnings volatility. Investors rewarded that story with a richer multiple. What quietly stopped working, at least at the margin, is the assumption that those flows and fees could grow forever, without a corresponding rethink of cost and technology. Banking revenues go through cycles. Asset management fees face structural pressure. Wealth management growth gets harder as competition for the same wealthy households intensifies. So management makes a capital allocation decision that just happens to be in human form. Cut 3% of headcount. The Journal notes that these cuts touch all three major divisions. That's important. It tells you they're not just trimming a weak corner, they're trying to reset the whole cost base. On screen, you'd be seeing a short Journal write-up. Morgan Stanley, roughly 80,000 employees globally, reducing staff by about 2,500, targeting layers of managers, support roles, and areas where deal flow and activity have slowed. You'd likely see references to prior cuts at other banks and to how this fits into a broader belt-tightening on Wall Street. Let's do the decision autopsy. What was expected when they built the current structure? That wealth management would continue to grow assets and margins. That global M&A and capital markets activity would remain robust enough to support a large advisory and underwriting staff. That asset management could gather enough sticky capital to offset fee compression. What actually happened? Markets have been strong, but deal flow has gone through a rough patch. Financing and IPO windows have been inconsistent. Global macro uncertainty, trade, war, rates, has made corporate decision-makers more cautious. Technology is increasingly capable of doing some of the analysis, reporting, and even client interaction that junior and mid-level staff used to handle. The opportunity cost of not cutting is simple. Every dollar of compensation tied up in legacy processes is a dollar that can't go into technology, into targeted senior hires, or back to shareholders. The hidden trade-off is cultural. When you lay off thousands, especially in a firm that built a reputation on being a winner, you risk morale, institutional memory, and client continuity. Most failures in financial institutions don't come from one bad decision. They come from success carried too far. Too many people hired into a model that assumed the last decade's conditions would persist. What we're seeing now is a corrective. As owners, we should be asking, are these cuts reactive, or are they part of a coherent reallocation? Do they come with clear investment in automation, in differentiated research, in better client technology? Or are they just a margin patch? The Journal doesn't have all those answers yet, but the scale and breadth of the cuts tell you management knows the old operating leverage won't cut it in the next cycle. Moving to next title, Stocks Rally, Bonds Bend. On the same page, the Wall Street Journal notes that major U.S. stock indexes rose on hopes that the Middle East conflict would be brief and contained. The S&P 500, the Nasdaq, and the Dow all climbed. At the same time, a weeks-long rally in Treasuries halted, pushing the 10-year yield back above 4%. On screen, you'd be seeing the standard market summary: equity indexes up roughly half to a bit more than 1%, the 10-year notes yield ticking higher, oil around the mid-70s a barrel. This is the visual of a market that wants to stay bullish and is willing to look through geopolitical risk as long as it doesn't see a lasting oil shock or a sudden change in the Fed. This is important for capital allocation because it shapes the discount rate everyone is pretending to use. A 10-year around 4% is a different world than the near-zero rates many of today's portfolios were built in. That rate is the hurdle Morgan Stanley, Fidelity, private credit funds, and even tech firms now have to clear in terms of real returns. Reality check: the current equity rally is happening alongside a bond market that is no longer an automatic support. The journal's bond tables in the back of the section show yields on government, corporate, and high-yield indexes with returns year-to-date. You can see that income is real again. A plain money market or short treasury now competes, psychologically, with a lot of alternative promises. For us, the lesson is simple. As the risk-free rate normalizes around 4%, the premium you demand from equity-like risk, private credit, venture, growth stocks should rise. If it doesn't, you're just transferring wealth to those who sell you stories. Moving to next title, Kraken's banking access. The journal reports that Kraken's banking unit won access to the Federal Reserve's core payment systems, making it the first crypto-focused firm allowed to move money the way banks and credit unions do. We're not going to talk about crypto as an asset class. The interesting part is plumbing and permissions. On screen, you'd be seeing a brief note. Kraken Bank, chartered in Wyoming, admitted to the Fed's payment rails. That means it can clear and settle payments directly through the system rather than relying on intermediary banks. From a business quality lens, this is about moats and regulation. Payments access is a gate. You cannot just disrupt it with an app. You either partner with someone who has it, or you earn it yourself over years of regulatory engagement. Kraken's management decided to go the hard way, secure a charter, satisfy the Fed, and become a direct participant. The decision autopsy here: expected, gaining direct access would reduce dependency on partner banks, improve economics, and make Kraken harder to deplatform in a crisis. Actual, after years of scrutiny, they cleared the bar, at least for now. The opportunity cost was enormous. Legal fees, compliance build-out, slower speed to market. The payoff is structural. If you believe in the long-term viability of this business, direct Fed access is a moat. If you don't, it's a sunk cost. The broader lesson for us is that the most durable fintechs eventually become, in key respects, boring infrastructure. They stop trying to route around the rails and instead gain a seat on them. Moving to next title, Brown-Forman, Whiskey Cycles, Tariffs, and Emerging Market Optionality. American spirits off most Canadian shelves for the rest of the fiscal year. That's the Wall Street Journal's description of Brown-Forman's reality in Canada after provinces stopped ordering American-made spirits following Trump's trade battles. For the owner of Jack Daniels and other brands, this is a live-fire exercise in geopolitical risk, hitting your P&L. The central figures are Lawson Whiting, the CEO, and Leanne Cunningham, the CFO. They are not the founders, but they are stewards of brands that have compounded for decades. Their job is to allocate capital between mature markets, emerging markets, marketing, production, and balance sheet strength. What worked for a long time? Premium American whiskey riding a global wave of cocktail culture. Strong brand equity enabling pricing power in the US and Europe. A stable export environment that allowed them to treat tariffs as a manageable nuisance, not an existential threat. What quietly stopped working was the assumption that your core geography mix would always be available. The journal notes massive sales declines in Canada because provincial buyers simply stopped placing orders for American-made spirits after the trade battles escalated. On screen, you'd see the journal's Brown-Forman write-up. U.S. organic sales down. Developed international markets down more. Emerging markets, Mexico, Brazil, Turkey, up in the mid-teens on an organic basis. Third quarter net income slightly down, but per-share earnings a bit higher thanks to buybacks and mix. Organic sales inching up about 1%, beating expectations. Behind that are two big capital allocation choices. First, what do you do when a whole region, like Canada, effectively shuts its doors to a key product category for political reasons? Brown-Forman can't fix trade policy. The opportunity cost is forced. You lose sales, you lose scale benefits, and you redirect marketing and inventory to other regions. The hidden trade-off is brand presence. If Brown-Forman bottles disappear from shelves for a year, what fills the gap? Local brands. European brands. Once habits change, it's hard to win that shelf space back. Second, how hard do you lean into emerging markets? The journal points out that emerging market organic sales are up around 15%, with Mexico, Brazil, and Turkey doing the heavy lifting. That's not random. Management is allocating marketing and distribution effort where growth still exists, even as developed markets soften. The risk is that these markets come with their own currency and political shocks. You're trading the slow grind of taxes and weak sentiment in Europe and Canada for the volatility of inflation and FX in places like Turkey. But if you're a long-term owner, that's the right direction. Young populations, rising incomes, and a growing appetite for branded spirits. The whiskey barrel story is also telling. Brown-Forman historically made good money selling used barrels to other spirits producers. Now, with the whole industry facing a tougher environment, demand for used barrels has dropped, and pricing has weakened. That's a small but pure example of how a tight cycle compresses secondary profit pools. The lesson: Brown-Forman is living the classic cycle where a global brand shifts from everything grows to mature markets stagnate. Emerging markets carry the load. The winner is the management that moves marketing, capex, and shelf war focus early and doesn't cling emotionally to historical geographies. Moving to next title: Campari, Aperol, Currency, and Pricing Power. Just below, the Wall Street Journal covers Campari, the maker of Aperol, laying out cautiously positive guidance for the year. They expect sales and earnings to grow, but they're explicit that tariffs and currency effects will temper that growth. Campari is another case of a brand-led compounder hitting the friction of macro reality. Aperol, in particular, has been a rocket for the company, turning a regional aperitif into a global lifestyle symbol. For years, that brand tailwind covered a lot of sins. Now, the central figures, Campari's leadership team, have to acknowledge that external headwinds matter. On screen, you'd see guidance language emphasizing growth, but with qualifiers, references to FX headwinds in certain markets. The capital allocation question is, how do you spend on marketing, distribution, and innovation when your gross margins are being nibbled by things you don't control? Tariffs and currency. Copying the past, just pouring money into the same mix of markets and channels, fails when your effective take-home on each bottle is being squeezed. Evolution is unavoidable. That might mean pushing harder into regions and channels where tariff impact is lower, adjusting packaging sizes and price points to protect perceived value, leaning on brand strength to push through selective price increases. The journal's tone here is measured. It's in the phase where the compounding engine has to work harder for each incremental point of growth. For us, the takeaway is that even the prettiest consumer brands are still portfolios of FX exposures and regulatory environments. The management teams that talk candidly about those constraints, as Campari's does here, tend to be the ones you can underwrite over a decade. Moving to next title: Microsoft versus the crimeware supply chain. There's also a story about Microsoft helping to shut down a massive criminal platform selling ready-made hacking kits, crimeware as a service. The journal explains that this was a marketplace where less skilled criminals could buy tools to run phishing campaigns, penetrate networks, and deploy ransomware. Microsoft and law enforcement partners took it down, disrupting a key node in the cybercrime supply chain. On screen, you'd see a description of the platform's scale: large, global reach, many customers. Quotes from Microsoft about the operation and the importance of breaking these ecosystems. Context that this is part of a broader push by big tech firms to position themselves as defenders of the digital economy. For Microsoft, this is not charity. It's capital allocation. They invest heavily in security teams, legal teams, and law enforcement coordination because their cloud and enterprise revenues depend on trust. If Azure is seen as unsafe, if Office is seen as a vector, their whole franchise is at risk. The decision autopsy. Expected. Investing in security and takedowns will protect customer trust, reduce losses from attacks, and strengthen their pitch to enterprises and governments. Actual. They notch visible wins, which the journal covers, reinforcing the narrative that Microsoft is a core security partner, not just a software vendor. The opportunity cost is that this money could have gone directly into visible features or shareholder returns. The trade-off is that security is now table stakes. The value investors' question is whether management treats it as such and funds it at the right level, not as an afterthought, but as a primary moat. Now towards last article, what the bond and fund tables are really telling us. Finally, the back of the business and finance section is full of numbers: bond benchmarks, yields, money rates, and mutual fund NAVs. Most people flip past them. As long-term owners, we shouldn't. The journal's bond tables show high-yield benchmark yields in the mid to high single digits, emerging market debt with yields north of 6%, mortgage-backed securities, munis, and agencies all offering meaningful income. The 10-year Treasury solidly above 4%. On screen, imagine rows of indices: U.S. high yield constrained, global high yield, emerging markets, munis, mortgages, each with a latest yield, a year-to-date return, and a range over the past 52 weeks. This is your opportunity cost map. When a risk-free or near-risk-free instrument pays 4% and high yield pays 7 or 8, you immediately know the spread you're getting for credit and liquidity risk. The journal's tables make that concrete. Side by side, you see mutual fund listings, big index funds from Fidelity and others up modestly year-to-date, some growth funds slightly negative, value and income funds positive. The dispersion is not huge, but it tells you that the easy beta-driven gains are tapering. The reality check: in this environment, the bar for alternative and illiquid returns is higher. A private fund offering you 9% with lockups and opacity is much less compelling when you can get 6 or 7% in liquid high yield or 4% in treasuries. The core lesson is that the tables at the back of the journal are where the real constraints show up. Every CEO, every allocator, every founder in the earlier stories is implicitly playing on that field. Their hurdle rates, their financing costs, their investor expectations are shaped by those yields. Lessons and ending. Looking across this issue of the Wall Street Journal, Morgan Stanley's layoffs, the stock and bond moves, Kraken's banking license, Brown-Forman's tariff pain and emerging market strength, Campari's cautious guidance, and the bond and fund tables, you see the same pattern. Leaders are being forced to admit that the environment they mastered is changing. Morgan Stanley is trimming people to make room for a more tech-enabled, lower-margin world. Kraken is spending years and real money to become part of the old rails it once hoped to disrupt. Brown-Forman and Campari are discovering that global brand power doesn't exempt you from tariffs, FX, or demand cycles. It just gives you more levers to pull in response. Microsoft is investing in security as a primary moat, not a side feature. The bond tables remind us that the free money era is over. Capital now has a real alternative return. 3 timeless lessons. First, incentives will always pull leaders to defend what they've already built. The rare ones reallocate decisively even when it hurts their own empires. Second, scale becomes a disadvantage when it slows your pivot. Big banks, big spirits companies, big tech platforms, they all face the same test. Can they change a little every year instead of a lot all at once? Third, the biggest risk to compounding is forgetting that the discount rate has changed. When cash and bonds pay you something real again, any strategy that still assumes money is free is quietly destroying value. The core question this issue asks us is, are we aligning our capital with people who are willing to change their own behavior as the world shifts, or with those still managing as if the last cycle never ended? The sentence I want you to remember is this: in a world where even cash earns a return again, the only businesses worth owning are the ones whose leaders treat capital as scarce and time as their only real compounding partner. This is Avi. Like and subscribe. On to the next.